Hey, what's going on? Emmett Dempsey, Treasure Coast Mortgage. Welcome to another video. Today we're going to talk about the loan estimate, or LE. It's your mortgage cost worksheet, and it's a very important document. This video is an update to this video here. It was in my original loan estimate video that I did. Most of my clients have already seen that video, but it was done in 2020. I also had braces on, so it looked a little bit weird when I go back and watch it. But I wanted to update that video, kind of talk about, what we're seeing, after 2020 with the rates up and down. It's very important these days to really know what that document is, your loan estimate, that's your settlement cost worksheet. And in a minute, I'm going to go back again and box by box, kind of going over all the different kinds of fees that you're going to see in a loan estimate. But it's very important to know when you're out there shopping, especially in a rising rate environment. So the loan estimate is the only form that we as mortgage brokers, mortgage lenders, banks, we all use the same form, because it's the only thing that we're standardized. So I present a lot of my options to my clients for either a mortgage coach, maybe some MBS highway stuff, and different. Every company has their own unique thing or unique form. But when it comes to brass tacks, the loan estimate is where the rubber meets the road. It's the only form that's standardized, where you can really compare and contrast different loan options to know if you're getting the best deal or not. And I'm going to go over every single box here in a minute. But without further ado, how about you guys go ahead and leave a like on this video? I really appreciate it. And if you haven't already, please subscribe, tell your friends. That's awesome. Without further ado, let's go ahead and take a look at the loan estimate step by step. Here we go. Okay, here is a loan estimate. Okay, this is a sample loan estimate provided by the CFPB. One thing that the loan estimate did, this came out in October of 2015. So if you got a mortgage before then, you might have heard about the good faith estimate and the truth in lending. So what this loan did, it combined the old good faith estimate, or GFE, into the old GFE and the truth in lending into one document in this loan estimate. Okay, let's go over the different terms here. Basically, the data was issued, the applicants, the property, sales price, pretty self-explanatory stuff. As well as, conventional, FHA, VA, or other, purchase, refi, etc. But one very key piece right here at the very top is rate lock, yes or no. Now, the only thing that lenders are held to is a locked loan estimate. So if you get even if you get a loan estimate like on a form, it can say anything. This has been in particular with different builder lenders. And other online lenders, they can just promise the world, but until that says yes and you have a definite lock confirmation, everything is still hypothetical. Okay, so a locked loan estimate is the only thing that is true about what you're going to see at the closing table. Okay, so just moving on here, here's your loan amount, your interest rate, your monthly principal and interest payment. The next box is your prepayment penalty. Now, for most mortgages these days, there is no prepayment penalty. Your conventional FHA, VA, etc. But there are some loans like non-QM loans. I do a lot of those. Your DSCR or bank statement. Sometimes they'll have a prepayment penalty in exchange for a lower rate on those different loans. Balloons, I don't do any balloon payment mortgages. I don't think there's very many of them out there anymore. But again, that's just a box that's on there. And remember, this form was created out of Dodd-Frank, out of 2008, the aftermath of all subprime. But a lot of those that environment is gone. So the current lending environment, a lot of these things are not relevant. Okay, so projected payments, and they have different years here because this is a mortgage insurance loan. This is a 90% loan to value loan. So basically years 1 to 7, they project mortgage insurance and also what your escrow is. Now, keep in mind, this projection is based off of you making your mortgage payment. So that that big amortization table says, year 1 it's this, or this payment all the way through 360 payments. So they project when you're going to fall below 78% on loan to value. But what's happening these days with the appreciation that's going on, many of my clients are getting rid of their PMI within a couple of years. But this projection here, that's why it says 1 through 7, because they project it's going to take 7 years before you're going to reach 80% loan to value. Okay, so that keep that in mind. Taxes, insurance, and assessments. If you have an HOA, property taxes, homeowners insurance, or other, or HOA. Your total estimated closing costs, okay, and it includes any loan costs minus any lender credits or other seller credits, and then your estimated cash to close is on the bottom line of page 1. Okay, so that's key. All right. And I'm going to go over that here. All right, so the different boxes here. Box A is your mortgage box. Okay, that's the only thing I have direct control over based off of what loan products that I go over with you and that you choose. That's what I can control. Okay, so discount points. So you research that. That's prepaid interest in exchange for a lower rate. And then sometimes there's also junk fees in there, like your underwriting fee, application fee. They just call it something else. But all is box A origination. Okay, so for those kind of loans. Okay, box B, that's services you cannot shop for. Basically, your appraisal, credit report, a flood cert, things like that. Now, one key point to note: most of the time, your appraisal fee is paid outside of closing through a credit card, but it's shown as a cash charge. So the loan estimate is always usually a little bit higher when you start off with for that reason, because the way that we depict it, we want to show everything that's going to be paid on the loan, no matter how it's paid. All right, box C is your services you can shop for. That's mainly title insurance, survey, and things like that. Many times the survey is ordered by title, but it is a service that you can definitely choose. Okay, so that's a title insurance, but here in Florida, most of the time the seller will pick the title company. So it's kind of weird that it's in box C that you can shop for it, but if you choose to have the seller pay title, then you have to use the seller's title company. Okay. Box D is just a sum of A, B, and C. Okay, that's the first part. Okay, and then up here, my taxes and government fees. Now, the recording fees are for what's for the local county to record the mortgage. So it's recorded in public records. Now, transfer taxes on this form is 0, but in the state of Florida, it's always going to be filled out because you have 0.2% and 0.35% for the buyer on the mortgage, and then 0.7% of the purchase price for the deed stamps that usually the seller pays, but not always. But we always show all three of those things, even if you're going to get a credit from the seller. Basically, the philosophy is like we show you, we charge you first and then credit you after. So sometimes the numbers will look scary, but then you get credits to offset them. But that's the way these forms are designed to be disclosed. Okay, box F is prepaids. Homeowners insurance premium, usually you pay your first 12 months up front, your per diem interest, depending on what day of the month that you close, okay? Also, and then box G is your initial escrow payment at closing. One key concept is that you're going to pay, for instance, for insurance, you're going to pay 12 months now, and your insurance is like, wait a minute, why I got to build an escrow? Because you got to build it for next year, because you take care of the closing date going forward for 12 months. Well, then your anniversary, your insurance is due, and taxes in Florida are due in November. So you got to do those then. Okay. Box H is your other, it's your owner's title policy. And then usually the seller will pay for that. It's shown as optional because technically it is optional, but it is always recommended because it's the only thing that protects you against any title defects, going back to the history of your property. Okay. All right. So box A is just, E, F, G, and H combined. And then J is total closing cost, D plus I, so D plus I equals J. And then lender credits. Sometimes if you bump your rate, so we can get a lender credit, that's how they would generate that. So if you can buy down your rate, or you can, I guess you can call it buy up your rate, and then you get a lender credit if you're short cash. All right. So this here, the calculating cash to close box, they just take it right from there. Any kind of finance closing costs, that's mainly on a refinance. And then your down payment from some borrower minus your deposit. And then sometimes you'll get seller credits. Mainly, I know in Florida, you'll get them for your doc stamps and whatnot. And then any adjustments, like, for instance, your tax prorations, things like that. So that all this gets figured into it. And this is your estimated cash to close. Now, many times, we don't usually know what they are. And I always, like I said, I always overestimate these. I keep these at 0, just to make sure that, we properly disclosed. And then once I get the closing disclosure, all those numbers come into focus. All right. So what's the other documents here? Okay. So these are the comparisons about in 5 years, you have paid this much in principal and interest, and the APR. Okay. So the APR, remember how I combined the old truth in lending? And this is where your APR is. Okay. So you can compare your 4.274 to your interest rate, of 3.875. So that spread is usually what those APR fees, finance charges are. All right. and your tip, total interest percentage, total amount of interest you pay over the loan term as a percentage of your loan. 30-year mortgages have a lot of interest, but the payments are low per month. And if you want to lower that tip, you get a 15-year, but your payment goes up. So you have to really pick your poison. Okay, so there's other considerations. Appraisal. Sometimes there's appraisal waivers only if the automated systems say so. Assumable loans. I don't think any mortgage that I do these days are assumable. I know FHA and VA used to be, but I don't think they are anymore. Homeowners insurance requires homeowners insurance. You may obtain from a company of your choice. It talks about late payments. Again, that's a throwback to the Truth in Lending. 15 days late and 5% of the principal interest. And talks about refinancing depending on future financial situation, and then servicing. The servicing transfer. Most of the time, they reserve the right to sell that transferring rights over that. So that's it for the loan estimate. Okay, hope that was informative. If you're in the mortgage market, you're looking to buy, sell, refinance, definitely give me a call. Here's the video that YouTube wants you to watch next. Thank you so much for watching, and I'll see you guys in the next one.